Welcome back to Switzer on Australia's Business Channel. So there are different valuation methods out there, obviously, because yours says don't buy Wesfarmers, but Macquarie's valuation method says buy Wesfarmers. So tell us the Wesfarmers story.
Most analysts and brokers are using a formula that I was taught at university and taught at graduate school. It's mathematically flawed, in my view. There's a mistake that people haven't spotted, and that's why you get these valuations that are too high.
Right, so, and one night we're going to get another person on, you're going on, and we have a real good old Barney over this really important issue.
But here's the great thing, Peter, it doesn't actually matter, because every time I buy shares, someone disagrees with me, they're selling their shares to me. So I'm used to it. You know, it's no problem.
But we still have, debates are good.
Okay, so Wesfarmers, Wesfarmers is worth significantly less than the $30 odd that it's trading at the moment. What do I think it's worth? Somewhere between $11 and $14. Now,
Richard Goyder would hate you saying that.
Well, here's the thing. They bought Coles. Remember the bank account? Let's go back to the bank account again. Coles had $4.3 billion in the bank account, and it was generating 27% per annum. That was Coles. That's what it was doing. Okay. Now, if you want... It was 25%. It was 25%. Doesn't matter. So let's say you and I want half that return. We want 12.5%, which I think is a reasonable return for the risk of going into the stock market and being in business. So 12.5% return, that's what we're after. The bank account's throwing off 25. So what can we pay for the $4.3 billion? We could pay $8.6 billion.
Yeah, you double it,
Okay, so you double it. You could pay Now, you happen to be the world's greatest retailer, and you're going to run Coles now, and that means you're going to get better than 25%. You might get 30%. So we could stretch it. Instead of paying $8.6 billion, we might bid $9.5 billion, maybe $10 billion. Okay, Richard paid $20 billion for that $4.3 billion in the bank account. Okay? That means that his return on equity, the return on the money, has dropped precipitously. It's dropped to 4–5%. Now, his job is to try and get that up. Now, what everyone is doing right now in Wesfarmers is precisely what they were doing in ABC learning centres. They sniff a turnaround and they say the profits are growing, it's all going well, but the return on equity is still low. It's not the most desirable bank account to own. And the market takes a little bit of time to catch up to that.
It's probably ABC learning centres, probably an unfair comparison.
I shouldn't compare Wesfarmers to ABC.
There are auditing problems. But you're talking about the popularity of the stock,
the growth, the excitement about the growth in profits. People are obsessed with growth. They're obsessed with the earnings that are coming out. They're obsessed with the dividends coming out. What they're not thinking about is how much money has had to go into this thing to get that money out. And a business owner is always concerned about the return on equity. They're concerned about how much they have to put back in to get the money out. Now, you've got to put you put in $20 billion. Okay, and the return on equity for Wesfarmers is going to be pretty mediocre for a while now. So, and look, and I've got a bit of a track record with Wesfarmers here. When they first made the announcement that they were going for Coles, the shares were trading about $37. They went to 44. And I was very, very public in my pronouncements that I thought it was worth about 22 or 23. It went to 14. Now it's gone up again because people think the story is good and it's turning around and they're grabbing market share from Woolworths. They're not looking at the right things. Okay,
but let's just say that your assessment of a Coles purchase being too much is correct. What if you're underestimating the calibre of the management? You actually did add a bit in, I know you added a bit in, but what if you didn't add enough? What if it really was worth 15 because Guy Russo's got Kmart right? And,
well, I think they're doing, by the way, they're doing a brilliant job on Kmart. I mean, the return on equity for Kmart, if you believe the amount of capital they've attributed to Kmart, well, that's fine, they're doing a great job. 19% return on equity there, or return on capital. But you're not buying just Kmart. You're not buying just Coles.
No, that's the point I was going to make before you rudely interrupted me.
Sorry. But excuse me for interrupting you, interrupting me.
That's right. That's my program.
Exactly.
But when you give your own program, also I won't interrupt.
I don't want to do that.
But the important thing is that what if the China story, that all the other businesses around outperform our expectations? And that's a possibility as well. Could that soften the negative view you've got on Wesfarmers? Because
I don't have a negative view on Wesfarmers.
No, but you have negative valuation.
Is the price. The price is $30, and the value is half that. You know, and less than half that. So I can't predict the share price. I don't know what the share price is going to do. No. I'm not good at that.
But you've already claimed it to be quite imperfect, the share price anyway.
The share price is imperfect. So at the moment it's factoring in all this upside, and I think most of the expectations, the positive expectations that you're talking about, are already in the price. And look, at any moment I might change change the inputs that I put into the model, into the black box and spin it around.
And you rush on the program and tell us.
And look, it might go from $15, $14 to 16 or 17, but it's not 30.
Okay. Before we go to the viewer question, so what are the main things people have to look for when they work the valuations out? So when they... Okay.
The equity on the balance sheet, how much is it? And you want to make sure the equity on the balance sheet isn't full of hot air, accounting hot air, what I call goodwill. If Wesfarmers paid $20 billion for Coles, about $14 billion it's more than that, $16 billion is goodwill. Yeah. If they paid $100 billion for it, the gap is still goodwill. It's just a misnomer. Okay. So we don't want too much goodwill.
Equity on the balance sheet?
Return on equity. Yep. How profitable is that business historically, and what's the expectation for the future? Yep. Return on equity and your discount rate, your required return. Yep. What return do you want, and how much money is being retained and compounded, and how much is being paid out? Okay, next time we come on, can you actually bring a balance sheet, show people where... We'll put it up on the screen. Yeah, and we'll show how they... Because let's do a hands-on. Well, that's next fortnight.
Yeah, and you show them where they get it from the ASX and all that sort of stuff, so people can actually do it. No problem. Roger, eventually the people of this country will understand what you're talking about. I hope so. And it's good stuff. Now let's go to the viewer question. It comes from Phil from Bangalore, and it goes... Okay, here we go. What is going on with Telstra shares? How does the market value them when we don't know what will happen with the split? I said this, it's a great question. We talked about it 2 weeks ago. Yeah. I said that, Telstra has seen the benefit of an increase in mobile phone penetration from 8 million to 22 million services. Internet in the home is 85%. 10 years ago, it was 30%. Subscription TV has increased 35%. So it was 0 10 years ago, 35 to 50% penetration now. And in all that time, Telstra's profits haven't grown. Telstra's profits are the same today as they were 10 years ago. Yeah. Okay, so how can you value the next 10 years when you don't know what it's going to look like? I said to you 2 weeks ago that my valuation was around $3. That's where the share price is now. I don't know what the business is going to look like in 3, 5 or 10 years' time. So my response to that is, I'm not going to buy it. Yeah. I just simply look elsewhere. So the guys at UBS today, I don't know if you picked up on this. Yes, I did all the research. Yeah, so put out a $4 target. Now, obviously, they're gambling that some decisions made by government will really help the intrinsic value of Telstra. Can you give us an example of what that might be, if they're right? Well, it might be that Telstra has the opportunity to do a Telstra, which basically means they can dominate the NBN, they can charge what they like to their competitors, and they can charge their customers what they like, and there won't be any regulation or restrictions around that. I suspect that's not going to be the case. No, I wouldn't thought so. And so it's very, very difficult to value. I think $4 is an optimistic valuation, if it is a valuation. Got to remember, sometimes the analysts aren't putting valuations on these things, they're putting a target price. So they're trying to predict how sentiment might shift. There certainly was a target price. Yeah. Okay, so if it's a target price, it's very different to a valuation. I don't know how they do that. They've obviously got a crystal ball that I don't have access to. Yeah. But I think, based on the economics of the business, it's not worth any more than $3. And if you were going to buy it believing in the optimistic future of the company and all those projections, well, you'd want to still buy it at a 10, 15, 20% discount to $3. Okay. Just in case there are some people out there who really have picked up on it and they're dying to get into a balance sheet over the week, give them a company that you like so they actually can work it through. And maybe that's the one you should bring on. So it's like homework and you bring the answer. The Reject Shop. Yeah, you always like the Reject Shop. And JB Hi-Fi is another one. Two good companies. Two good companies worth looking at. And you select one of those. I'm not saying you buy them, but worth learning how to value a company, because nice clean balance sheets and P&Ls. It'd be interesting for people to work out what they get and then what you actually show us on TV next week. Let's do that in a fortnight. All right, mate. Excellent. Great seeing you, as always. Thanks.